been a tough 72 hours for banks in the US. The bloodbath on Wall Street showed how tough the situation is going to be. Financial institutions continued to plunge at least their stocks, and they got walloped by investors. On Wall Street, counters like First Republic, Credit Suisse, Charles Schwab got a beating, hitting lower circuits. But there has been a recovery in the last few hours. In fact, the Dow Jones right now up about 300 points, and the Nasdaq also up in the green about 1.5%. The bet on Wall Street seems to be that this rout in the banks will force the Federal Reserve to pump the brakes on further interest rate hikes, because that's the primary reason for what we've seen in the last couple of days. Now, earlier this evening, US President Joe Biden, in an address, assured Americans that their deposits are safe in banks. Clearly, equity investors don't feel the same way about banks. It started last Friday with the collapse of Silicon Valley Bank, the banker to startups, and then New York-based Signature Banks. In both cases, the Federal Reserve acted swiftly to try and stop a contagion, but the fears have spread. With the Bank Nifty down about 2%, Sensex lost nearly 1,000 points today in trade. And the fears don't just extend to banks. Startups are feeling the heat. Companies whose deposits are stuck with Silicon Valley Bank are wondering how they will make payroll. In India, startups with exposure to SVB are wondering what next. Nazara Tech subsidiaries, for example, have about 64 crore rupees stuck, though they say it's not going to be an issue. So what happens next? Let's first listen in to what Joe Biden had to say.
No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Investors in the banks will not be protected. We must get the full accounting of what happened and why those responsible can be held accountable.
All right, to speak more on this, I'm joined now by Ajay Bagga, Chairman of Elements Platforms and Market Expert, Geoff Dennis, Independent Emerging Markets Commentator, with me on the show. And I'm also speaking today with Mythili, Bhusnurmath, Consulting Editor, ET Now. Welcome to all of you, and thank you so much for joining us as we try and unpack what's happening. Now, 2008 jitters yet, Mr. Bagga? Or is this, still something that can be brought under control?
It's still something that is being brought under control. The stock market sell-off, Tamanna, is because it's become very binary. Either the bank will survive and you will get a better price for your stock holdings, or it will go to zero. So people are selling off their bank holdings because the government, the US government, is very clear that they will protect the depositors, but not the equity owners or bond holders of these banks. So we are seeing a sell-off in the financial space, and which is going around globally. But I don't think we have the complexity of 2008. There is not that kind of lending which has happened and which is coming home to roost. This is more an asset liability mismatch and an interest rate risk coming home to roost that is causing this. It's not a 2008 scale yet, is my personal assessment as of the information I have.
As of now, it's not of that scale, but the speed with which the news is developing is certainly scary, and we're in a world which some would argue is even more globalized than before. Geoff Dennis, what is the story of Silicon Valley Bank's collapse? Is it bad timing? Is it a perfect storm, or is it greed?
I don't think it's either of those, actually. It could be bad timing. I think it's basically mismanagement. I don't think it's greed. Basically, what seems to have gone on is because this bank was a heavy lender to tech startups, and you've had this massive pullback in the tech sector. Generally, capital has not been raised by these tech startups recently. Bank lending to these more established tech companies has fallen sharply. So the bank had to find other places to put their money. And so they put their money into a lot of bonds, both corporate and government bonds, and they didn't hedge their positions. And so I think that's what's going on here. So to not hedge your positions in these bonds is what the big mistake has been. And I think to a large extent, SVB was a fairly unique situation because of its focus on the tech sector and frankly, because of its mismanagement of its bond portfolio.
Mythili, today, of course, banking stocks in India also hit, and it's obvious that we have a very different system. There needn't be any worry, but I think it's worth reinforcing how differently Indian banks are regulated and whether there are any fears of contagion at all.
Well, Tamanna, it's a little early to say because yes, Indian banks are differently regulated, but the fact remains that that was true even in the case when Lehman went down. So the fact is that when you have a collapse abroad of a significantly large bank, there is always the fear of contagion, which is why the US Fed and the Treasury have acted. If there really was no fear of contagion, I doubt they would have acted so quickly, or that the Fed today is holding at 11 a.m. US time, the Fed is holding what is known as an expedited meeting of the US Federal Reserve. Clearly, they see a reason to do that because they're not so sure that the contagion can be entirely contained. And if that contagion is not contained, because banks, as you know, are all very highly interconnected, there is a fear. Yes, at the moment it may not be very large, but there is a very distinct fear that it could roil the entire world at a time when the Fed does need to raise interest rates to contain inflation, which could further damage bank balance sheets. And if there is that kind of contagion spreading across the world, India will not be immune.
Why exactly would Indian banks be vulnerable, Mythili? If I can ask you for a little more detail on that.
Well, whenever there's financial crises anywhere, simply for the same reason that when Lehman's exposure was to subprime banks, but even so, when Lehman went down, it did have an impact on the entire world, simply because when there is fear in one part of the world, in the financial sector, banks are so interconnected that it would have an impact on what happens in India as well. See what happened after Lehman. Because the US had to take so many actions to prevent the banking system, at that time, in fact, the Fed did not come to the rescue of Lehman, which is why, in fact, we saw the financial crisis happen. Today, in fact, the US is bailing out the two banks, though the US president has taken care to say it is not a bailout. In the case of banks, there is no escape from using taxpayer money. So the Federal Insurance Corporation has insured insurance only up to $250,000. The large part of the deposits in these banks is beyond the insurance limit. So when you say that all deposits are safe, it is with the taxpayer money. So precisely because this time perhaps the Fed has learned from the mistakes of Lehman, we might not have seen that kind of impact. But the fear is always there. And when there is fear, there's always a flight to safety. And that is likely to impact the Indian banking system too.
Safety is visible in surging gold prices in the latest numbers coming in. Geoff, Dennis, there seems to be a feeling that this is what's going to force the Federal Reserve to pump the brakes on further interest rate hikes. Interest rate hikes and the consistent interest rate hikes has sort of become the villain of this piece. Is that the way you see it? And do you think that the Federal Reserve will have to change tactic?
Oh, yes, I do think they'll have to change tactics. When I was on your network last night, 12 hours ago, I said they would probably go 25 basis points, not 50 at the next meeting. And that was a pretty good chance they actually don't move at all. Whether this will be the peak in rates, of course, or whether they just wait and then start to tighten further down the road will depend on two things. First of all, how quickly this contagion is contained. And I personally think it probably will be contained reasonably rapidly. But will also depend on inflation. The inflation reports, of course, we're getting another one of those reports tomorrow. Now, what's going on with this special Fed meeting, I think, is an interesting speculation. There's been some talk they could cut rates. I think that's probably a little premature, but that's a possibility. I think more likely is that this new facility they have created, which is designed to provide support for other banks that may be about to or are suffering a run on their deposits, that facility could be increased. And I think that could be what this meeting's all about. But for sure, it's going to slow the rate hikes down for now without any question. And indeed, this could be the peak in rates because of this latest crisis.
You know, the other aspect to all of this, of course, is what's happening with startups and how Indian startups will be impacted. If I had to look at it and this entire story in terms of impact, we could break it down into, you know, the stocks of banks listed on Wall Street right now. By the way, just as an interesting aside, cryptos are soaring. Cryptos are soaring. Suddenly, Bitcoin up 4,000. So a lot going on right now. The other end of the impact really is what happens to startups who had money in Silicon Valley Bank, including Indian startups. Ajay Bagga, how concerned are you there?
That money will come back. The US government itself has given a guarantee. So I think today itself they will see a substantial portion of that money. What was happening, Tamanna, was they had more of a asset liability mismatch, a more a liquidity mismatch, and because of the interest rate moves, they would have to book losses every time they sold bonds. So they sold $21 billion out of their AFS portfolio and made a loss of 1.8 billion, tried to raise equity to cover that hole, and they could not get anybody to give them equity. So they had to go back to the regulator, and the regulator took them into receivership. They've not had huge bad loans. They have a lot of government bonds and government agency-backed mortgage bonds. So it's not that it's a meltdown like a Lehman. That's why I'm pretty confident it's going to be short-lived. And it's a demonstration effect that the Fed has brought in, that I'm sitting with this trillions of dollars of bazooka. I will lend at 1 year OIS plus 10 basis points, so maybe 4.5, 5%. I will lend for 1 year at par, not at the MTM level, but at par. So you're giving a breather to banks, and with that line, banks can then reassure their depositors. I think the regional banks are feeling the heat. We have seen quite a few names down, seeing very big cuts today. Those are all regional banks, Tamanna, all under the 250 billion asset level, which in 2018, the Dodd-Frank was, in a bipartisan move. The Dodd-Frank limit was raised from 50 billion to 250 billion. And that's where, if you ask me, the issue lies. Lesser regulation, lesser stress test, not being subject to the strict controls.
But I just want to understand one statement you made, because, you know, the American government has made it clear that depositors will be made whole. The insurance limit is $250,000. Where will the rest of the money come from? Because he's also saying taxpayers won't be stressed.
No, you have the bonds.
So someone will have to take some losses.
No, that is if theoretically 100% of the depositors want to come in, then you will have to find other liquidity. Suppose you look at Silicon Valley, they have lent out $41 billion to various people that they cannot sell to the Fed. So there will be a hold to that extent. They can't liquidate that. So there will need to be a backstop facility. They have 1.1 billion of fine wines that they are holding in some cellars. So they will have to sell that fine wine and realize whatever they get for it. But the rest of the deposits will be paid for by putting these bonds up at par to the Fed. So the US taxpayer will not pay. The 5% that Silicon Valley will have to pay to the Fed will be used to take care of the expense of this. But you're right that 40 billion of loans that they have given, how much of those are backstopped with actual deposits? So they were like unfixed deposits, or were they clean lines? That is not so clear from just one balance sheet that we are seeing. So I think a lot will go into that. But overall, for banks, since you are able to offer your bonds at par, so you don't have the MTM haircut, you will be able to cover substantial portions of your deposits. and 100% of people will not come running. If you look at Silicon Valley Bank, 89% is above the insurance limit. So 11% anyway FDIC will take. 20% is your loan book. So there I don't have an answer right now. We'll get some answers, I think, down the line. But the rest of 65% is in very high level, very highly rated bonds, which the Fed will accept. And
Okay.
they'll give you a
I
line.
like that. I like that comparison of fine wine in the cellar. Let's talk about the Indian startup connection because this bank has stakeholders in India. How will this fallout impact companies here? Sharad Dubey has these details.
Well, yes, almost 20 companies are there in which SVB is actually invested in India. And of course, in the weekend, there was an important development coming in where Vijay Shekhar Sharma had stated that SVB is neither an investor, neither a current shareholder in Paytm. Now, of course, without Paytm also, we see the investments coming in, that's coming to the tune of almost $1.1 billion. So there are certain startups also having tie-ups over here, such as ChargeBee, Postman, CleverTap, where there is a financing or the banking relation is there with SVB as well. And apart from that, also Nazara Tech yesterday explained that almost $7.75 million of exposure is there amongst its two entities. Apart from that, also Y Combinator-led startups, especially from India, most of them have financing agreements with SVB. Now let's look at the numbers, how they actually pan out of the investments made by SVB in India. Next Paytm, there are big names such as InMobi, Bharat Financial Inclusion, Naptol, and all these important startups which are there, which are having the tune of more than $100 million exposure as SVB is investing in India. Now you can see these numbers coming in your screen. Apart from that, also Blue Store and Tutor Vista make it to the list. Now this data has been coming from the latest updated data coming from Traxon. Now also Axel, that itself is a VC firm that is also having almost 35 companies are having a tie-up with SVB on this, and that is something to watch out for. Apart from that, the question remains is what lies ahead for the Indian startups, and that's the important thing. This includes no new recent round of funding has actually happened by SVB, and the fundings which have happened were on low ticket sizes. Apart from this, the most SaaS companies in India which are having large exposure in US, they do have credit lines with SVB, and sentimentally there might be an impact as over the weekend the US VCs asked the founders to withdraw or limit their exposure to SVB. But what are the ecosystem members stating about it, and especially in the theme of India itself? Let me explain you that VCs are saying that there is enough dry powder in the system in the Indian accounts as of now. Apart from that, the government also will start meeting startups this week to discuss the impact of the SVB crisis, and Fed also actually stated today earlier in the morning that they'll be making available the additional funding for the startups. And lastly, even the UK's PM also stated that there won't be any contagion risk.
All right, Mythili, do you agree with that assessment broadly that there will not be any risk for Indian startups? And is this also highlighting, again, how vulnerable we are in an increasingly globalized world?
Well, startups will find it difficult to find funding and startups will be affected. But I worry much less about startups because the impact on the Indian economy is not so significant. They might be large in number, but the overall impact, their ability to cause damage to the Indian economy is limited. I worry much more about the systemic risk to the banking sector and to the entire economy because of the globalized world. So we must hope that the Fed tonight when it meets, our time tonight when it meets, it does not actually realize that the situation is far worse than they envisage. And I'm not remotely as optimistic as Ajay. Fine wine is all very well, but it really cannot save the world from risk if the risk is not contained, and contagion does happen. To the extent that the Fed has learned the mistakes from the 2008 crisis, I think they will try to contain it, but there will be an impact on taxpayers, and what it means for the Fed's further rate hikes at a time when US inflation is still very high remains to be seen. So rest assured that we will not escape entirely unscathed.
Just want you to respond to that. Impact on startups and overall fears from what we have seen. Is this SVB story going to sort of wrap up in the next couple of days and that's the end of it? Because these things tend to be very unpredictable, as you will remember post 2008.
Who's that?
Ajay Bagga. The question is for you. Yeah.
Okay. The link missed out my name, so I heard the last half of your sentence. So first to Mythili, I was making a sarcastic remark that a bank was holding $1.1 billion of fine wine that is there in in their balance sheet. You can check it out. I don't endorse it anyway, so it shouldn't have been there. It's a debt capital. Even if it's an appreciating asset, it's not a bank's business to be holding $1 billion of fine wine. That was my point, not anything else. So your comment was uncalled for. Second, this emergency meeting you're making so much about, these are normal meetings. It's nothing is going to come out of it. It's not a decision-making meeting that they're holding. It's a review meeting. So this happens, and every time we have some, people who start highlighting it. Oh, it's an emergency meeting. It happens every 3 months. It's a usual meeting. It's called an emergency meeting because they call it like that. They don't give the 21-day notice. Now, coming on the startup thing, Tamanna, we are in a funding winter as it is. Global private equity has fallen 36% in terms of, their funding to startups over the last year. India has seen its fair share. So there is a funding winter on. This will exacerbate it. Raising funds for PEs will be difficult. And secondly, they will be more careful in giving money out. Third, what was happening was a lot of Indian startups were being forced to set up Delaware corporations. And that's where the SVB, Connect would come in. It was ease of operating. And the Ps would be more comfortable with Indian corporations having a base in Delaware. A lot of the SaaS companies that were mentioned. That was what was happening. That will, be, I think, scrutinized by the Indian regulator also more closely, because even though the money is being invested in an Indian company, but the company becomes American and the IP and everything goes with it. Just to give you one statistics, last year, Silicon Valley made about 40% of the IPO proceeds of the technology and healthcare sector were parked with it post the IPO. So it was a very good bank. It was managing to meet the requirements of startups and people raising funding. But I think somewhere in risk management, it missed out. The government is taking control. Hopefully, they will limit the damage. Rest, any of us, it's anybody's guess how far the damage goes. I agree that there is no decoupling. So if US falls very strongly, we'll also have to fall. There is no escape from that, because capital is globalized. And if GEM funds are selling, emerging market funds are selling, we get our fair share of 13-14% of that flowing out, and 30% of your market is financial. So we see the hit on financials and IT as we saw today. That will continue. So what we can do is hope for the best in terms of that. Tomorrow's US CPI number, very critical.
Right.
And then 22nd March, what the Fed does.
I think something may have gotten lost in translation, Mythili. So do you just want to respond? I think we were taking Mr. Bagga's comments as an analogy, and he was saying something quite literal.
Absolutely.
It's actually on their balance sheet. It's there on their balance sheet.
I thought it was an analogy.
I was criticizing them.
Yeah. So
I'm not smart enough to give analogies. No.
Okay.
It's there on their balance sheet.
So that was lost in translation. Yes, Mythili.
No, absolutely. I think he took it more seriously than it was meant to. The fact is that there was mismanagement, and I think the very fact that the Silicon Valley Bank did not take action when you knew interest rates were going to rise. It is amazing that the US Fed has been raising interest rates for almost a year.
Exactly.
What was the bank doing? What were the supervisors doing? So I think it's a case of gross negligence, both by the bank as well as the supervisors in the US.
Exactly. It was no secret that interest rates are being, hiked.
Tamanna, you will be surprised to know that there was no chief risk officer from April till January. So for 8 months, there was no chief risk officer of a 200 billion asset and 175 billion liability company. It would not happen anywhere else in the world. It might not be a red flag. At least it was a yellow flag, which any regulator should have picked up. And it's a question of how the US regulations are set up. This is a state-controlled bank. It is not a central bank. So it comes under the state oversight. Second, in 2018, it was very conveniently the supervisory limit was raised from 50 billion to 250 billion, but a 250 billion bank going down, it upsets the entire system globally, not only in the US. So I don't know how this was done. And it was a bipartisan move, Tamanna. It's not that you can
today,
blame.
that's interesting you say that, because today Biden is blaming the Trump administration. And
No,
let me get
everybody passed it.
let me get Geoff Dennis in on that. Joe Biden blamed the Trump administration, saying under them they made all the rules lax. We're going to tighten it now.
I just think that's unfair. I mean, I don't think that's correct. I mean, don't get me wrong, I'm no Trump supporter, but I just think that's unreasonable. I think the issue here is that, or one of the major issues here is that you have hundreds and hundreds of regional banks in the US doing all sorts of different things. As we've learned from SVB, doing things that they shouldn't be doing. And I agree with your other speakers, because basically it was mismanagement, whether they had a risk officer or not. It was mismanagement because they didn't hedge their bond portfolio. That's what's gone on here. And I think one of the things that's going to flow from this is an increased focus on trying to consolidate the US banking system into a much smaller set of large banks in order to prevent a relatively, well, not a small bank, but a regional bank here, essentially regulated by the state of California, presumably, not blowing the whole system up, because it won't blow the whole system up, but leading to all these stresses. Right. I'll start with what I said before. I think this contagion will be containable, and it will be containable because ultimately the Fed will increase the size of this support facility they've just announced on Sunday evening. And I think you may well see one or two other smaller banks go to the wall, but I would be very surprised, given the capital positions of US banks generally are much, much stronger than they were in the run-up to 2008. I'd be surprised if this spreads far and wide across the US banking system, leading to a 2008 type global financial crisis. That's really my basic view here. Absolutely. But to blame this all on ex-President Trump, I think is probably unreasonable.
Well, let's hope for the best and hope that this definitely doesn't spread, but important lessons to be learned here. Thank you to all of you for joining us. Meanwhile, cryptocurrencies are surging, even as the Biden administration says they will stem the rot in the banking system. Bitcoin has surged about 10% in trade at 24,300 levels. Ether is also up about 9%. The surge in riskier assets comes after FDIC moved SVB's deposits to Bridge Bank. Moreover, a section of traders is betting that the Fed will be more cautious in rate hikes after the failure of SVB and Signature Bank. Meanwhile, let me just go